Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Hey, welcome back to Navigating Retirement. I'm your host, Rick Durkee. Thank you for joining us today. Got a really interesting show today. Want to talk about some issues and some opportunities for you today to do some financial planning. I want to also mention that this year is already flying by. Here we are in March of 2021, 2 months down, and this year is really already shaping up to be quite an interesting year. Certainly, there's been some surprises. There's some opportunities for us savers and investors and planners to be concerned about what might lie ahead in our new administration, new taxation, things like that. So make sure that planning takes into account both predictable, what we believe will happen, and to the extent it's possible, the things that are unexpected or cannot be controlled. So let's go into some ideas today. But first, I'd like to give a shout out to all of our women listeners. It's International Women's Day on March 8th. And we'd like to acknowledge that fact. Hey, this week, we're going to tip our hat to the ladies in our lives, our wives, perhaps the single mothers that are out there, people that are working their financial businesses and lives on their own. And we'd like to make sure that we understand that when it comes to planning for women, there's not a whole lot of difference than planning with men, but there is one issue that we've spoken about before that we certainly should always plan on in our retirement income plan for a husband and wife, is the fact that women do live longer than men. They might have some longevity issues and some planning issues that we need to plan on now while we're both alive and well, the husband and wife, but we may have survivor issues in the future, and income may change or income sources may change for our wives. So when we're talking about longevity and we're talking about women that live longer, I think it's always appropriate to mention that longevity risk is one of our biggest risks in retirement. You might be asking yourself, why? Well, longevity risk is a risk multiplier. It's simple. The longer we live, the more things that can happen to us. Now, they could be good things. Our market investments could go up because we had longer for them to grow. But on the other hand, there could be some issues that come up because we live longer. If we live longer, our money has to last longer. We're simply going to spend it more over time. If we live longer, we might see higher probability for income taxes increasing. We might see inflation increasing as it has in the past. We may also see healthcare step in the way of some of our plans. So remember that longevity is something that we should manage. We are happy that we're living longer. We're happy that medical science has allowed us to live longer, healthier lives, but let's do the planning that we understand that longevity risk is that risk multiplier. So that's a big risk. Today, we want to talk about 8 moments when you maybe should move your money. Now, move your money, move it from where? Move it from the banks to other safe money havens? Move it into the market? No, we're not talking about that today. We're really talking about opportunities that you have from really a management standpoint of your money. I had a Greek immigrant who was one of my mentors always tell me this story. He said, Rick, you need to let your money do the work for you, okay? Moving your money, rebalancing your money, getting your money to work harder for you is the key, because at one point in the future, your money is going to be creating your income. it's going to be doing the work for you. Today, we do the work to create our paychecks, and in retirement, our money is going to be creating the paychecks for us as we live off the interest and the growth. So let's talk about some of these moments when you should move money. When you're doing investment planning and you're investing, oftentimes rebalancing comes to play. You might be diversified in your portfolio, and at certain times of the year, or if you measure things from a beginning of the year to the end of year basis, you should rebalance your accounts. You might have some accounts that are invested in different asset classes. You might have some accounts that are invested in different sectors. For example, you might be in different sectors of the US stock market. And what you do is when you rebalance, you look at a point in time and you say, wow, this one did really well. And if I continue it in there, I may have a risk that it may snap back and it might go down. So we have to rebalance that account, take some of those profits off the table, throw them into one of the other sectors because it may be on the way up. It may have some positive momentum. So constantly actively managing your account is very important. You're not only looking at it from risk standpoint, you're looking at it from a reward standpoint too. And when should I take profits off the table and get things equal again so that everything has the opportunity to grow when the time is right? Roth conversions, another great time to move money. Now, I've mentioned this in prior shows. We did a webinar this year on taxes in retirement. We spent a lot of time on Roth IRAs and Roth conversions. Now is a perfect time for the Roth. It's a great opportunity. So if you don't have a Roth, we need to get started. If you do have IRA dollars already, maybe you're in retirement, we may want to pay some taxes now while we're in this year, while taxes might still be low. And then in the future, we can let those Roth IRA dollars grow income tax free by paying the taxes on the IRA dollars now and converting them into Roth IRA dollars. Definitely a process to go through to evaluate how you pay income taxes on that money. You don't want to do it probably all one lump sum, put yourself in a higher tax bracket, pay more money on that conversion than you need to. You need to sit down with us at the Coastal Financial Planning Group, do a Roth conversion analysis, and then let's run it by your tax professional. Let's make sure that this fits based on what we anticipate your income to be, maybe over the next 2, 5, 7 years, and let's do little Roth conversions over time so that we manage your taxes and your income taxes on those conversions. Hey, here's another time when you might want to really consider moving your money, age 59 and a half. Why is that? Your 10% penalty goes away from the IRS at age 59 and a half for withdrawing funds out of retirement accounts. Now, so if you're looking at moving money from a 401k, you may have an opportunity, even though you stay at your same employer that you're with and they keep on matching your contributions, so you keep on making contributions into your 401k, you may have the option at 59 and a half, you need to check your plan document with your employer for your 401k. You may have the opportunity to do a non-hardship in-service withdrawal provision after 59 and a half. What does that mean? That means you're able to self-direct your IRA investments when you move the money from a 401k into an IRA. Great opportunity for you to do some planning. Again, we offer those services at the Coastal Financial Planning Group. We'll research in your 401k, see if you have that non-hardship in-service withdrawal provision, and if you can self-direct your IRA. Oftentimes what we found is we can save money in fees when we move out of those 401ks, and we have a much more diversified investment portfolio. And here's one other thing. You can develop income planning tools inside of your self-directed IRA so we can start making or lining up your income streams for retirement. All thoughts for age 59 and a half. When you leave a job, a lot of times people leave their 401k behind. I've had people call up and say, I had this employer and that employer. I'd like to consolidate all these. I don't know what the event is that creates these people's urgency to do this, but I would say as soon as you leave the employer, you need to think about moving that money into your own self-directed IRA. Why wouldn't you want control of your money? That's your retirement dollars, your future retirement dollars. Here's another reason you might want to move money. Your fees might be too high where you're at right now. Now, a proper fee analysis may be difficult for most, but there is information. All this information is properly disclosed by your financial advisory firm or your financial advisors. You can find the information. You need to ask the question, though, what are my fees? How much am I paying? Be fully inquisitive when you ask this. Keep on asking, is that all? Is that all? Is that all? Because there are a lot of fees in different type of products that are really, I would say, they're disclosed, but they're under the covers. They're in that big, thick book that you get every time you get an investment called a prospectus. Expense ratios for mutual funds or ETFs or whatever that your advisor is recommending for you all needed to be added up with that wrap account fee, okay, that you're paying, or any other fees, because that's a fair assessment of what your total fees are. Here's another reason you should consider moving money. We're looking at 8 reasons to move money. Underperforming assets. Of course, we want our assets to grow. Okay, that's just obvious. But oftentimes we'll just let them go and we'll say, well, they lost a little bit of money, they should come back. Okay, let's look at those underperforming assets and let's find out if there's other like kind investments at the same risk or maybe even less risk that could provide us with more growth. On the same hand, if we're doing an analysis of, say, a stock portfolio and we're looking at underperforming assets, we might want to sell those assets at a time when we have overperforming assets. We might want to take some of those stock profits off the table when that stock value gets high, sell the underperformers. Then we have no taxation because the offset gains are offset by the winners and the losers. It's an equation, folks. It's easy to do with our help at the Coastal Financial Planning Group. When you're using after-tax dollars, you want to make sure you factor in the tax cost basis. And again, we enlist the help of a financial professional, a tax attorney, a tax accountant, a CPA, an enrolled agent, someone like that that can make sure that we're making the right moves for your individual tax situation. Next on our 8 opportunities to move your money is your time horizon is changed. Maybe you're going to retire a little bit earlier. Maybe your health has changed. Maybe your options of what you want and need your money to do for you have changed. So your time horizon, we need to look at time horizon because that relates to how much risk we have on our investments. If you know that you're going to need that investment to be converted to liquidity and cash on a short-term basis, the risk needs to be reduced. I can't tell you how many times I've seen people, say, well, I really need to use this money in 3 years or something like that. But I want to put it in an investment. I want to get that money in the market and get it to work for me. Well, let me tell you what, if you need that money in 3 years, you got no business being in the market, because what if it takes a 20 or 30% drop and takes you about 2 years to get that money back, and you're in year 1 right now? Guess what? You're going to take that money back and you're going to be paying a pretty hefty charge because you just cashed out and your market value is lower. So keep in mind your time horizon. Longer you can invest, the more risk you could take. Here's the final opportunity for you to think about movement of your money at this point, and that's just consolidating accounts. You've got accounts all over the place. Let's put them in one basket. Let's put them at the Coastal Financial Planning Group. Let's put them in your retirement income plan. Let's watch those assets grow. Let's make sure they're protected. But consolidating the accounts into, say you've got 4 or 5 different IRAs. Let's put them into one management program. Let's have their objective always be to fit into your retirement income plan. And if we do that over time, we're going to see surety, we're going to see confidence, we're going to see the ability for you to self-direct your investments, lower your fees as we talked about before, hopefully lower your risk and get higher returns. And all those sources of opportunity are available for you here at the Coastal Financial Planning Group. Hey, give us a call today, 843-735-5065. We'll take you through our 3-step review process. We can do it online, we can do it Zoom, we can do it on the phone, we can do it in person, the old-fashioned way if you want to sit eyeball to eyeball. We've got a conference room here that we've met many people and helped many people do their savings and investment planning for their future, develop their retirement income plans, and we look forward to the opportunity to help you. I'm Rick Durkee. This has been another edition of Navigating Retirement. We look forward to having you back for future episodes.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.